Hi everyone, and welcome back to Trade Your Own Way. Before we begin building trading strategies, we need to cover the essentials. Today we'll be looking at the 5 primary charting elements that will serve as the foundation for everything we'll be doing on this channel. Think of this as your self-assessment. Right now I'll give a basic explanation of each of these elements. If you're completely comfortable with each, you should be ready to continue. If not, don't worry, I'll break down each element in much greater detail in upcoming videos. These 5 primary charting elements are candlesticks, timeframes, moving averages, RSI, and ATR. Let's get started. Let's begin with candlesticks, which are the standard way of visualizing price movement on a trading chart. Each candlestick tells a story about market behavior over a specific time period by providing 5 key pieces of information: direction, open price, swing high, swing low, and close price. A green candlestick means it closed at a higher price than when it opened, while a red candlestick means it closed at a lower price than when it opened. By understanding these 5 details, you can quickly and easily interpret what each candlestick tells us about its time in the market. Timeframes split market data into distinct intervals, defining how much price movement each candlestick represents. For example, on a 1-minute chart, every candle shows what happened in that single minute. On a 1-day chart, every candle shows a full day of price movement. Shorter time frames reveal a lot of detail, but also show more rapid ups and downs. Longer time frames show you a broader view of where prices have been heading over time. By looking at more than one time frame, you can understand both the overall direction of the market and the short-term changes. Moving averages are indicators that show the average price of an asset over a specified number of periods, helping to smooth out short-term fluctuations and highlight overall trends. Think of a moving average as a way to see the bigger picture of price movement rather than every small change. For example, a 10-day moving average takes the closing prices from the last 10 days, adds them up, and divides by 10 to get an average. Each day, a new data point is added, and the oldest one drops off. The simple moving average is the basic type of moving average which treats all past data points equally. The exponential moving average gives more weight to recent prices, so it is more responsive to new market changes. Whether you use a simple or exponential moving average, the goal is the same: to help you make more informed decisions about market trend. The Relative Strength Index measures how strong recent price movements are, showing whether a market might be overbought or oversold. RSI is displayed as a line moving between 0 and 100. The middle of the scale, at 50, is considered neutral. If the RSI goes above 70, the market is often called overbought. This may suggest that price has moved up too quickly and could pull back. If the RSI dips below 30, the market is referred to as oversold, suggesting it might have dropped too quickly and could bounce back. The RSI offers a quick sense of how strong or weak the current trend is and how quickly it's been moving. The average true range measures how volatile a market has been by calculating the average distance between the high and low prices over a certain number of candlesticks. ATR factors in how far price moves, on average, within each candlestick over a given period. A higher ATR means the market has been moving more dramatically, while a lower ATR suggests smaller price changes. ATR only indicates how far price might move, not which direction it will go. We've just covered a basic overview of 5 fundamental tools for analyzing price action. Candlesticks, which show how price moves within a specific time. Timeframes, which sets the length of time each candlestick covers. Moving averages, which smooth out short-term noise and highlight broader trends. RSI, which gauges the strength of recent price movements. And ATR, which measures volatility to help manage risk more effectively. Mastering these concepts is your first step towards building your own trading strategies. Keep an eye out for upcoming videos, especially as we begin diving into the charts. Thanks for watching, and I'll see you again soon.